Today we're jumping right into a really significant player in Turkish industry, Kardemir. That's Karabük Demir Çelik Sanayi ve Ticareti.
Yeah, a major integrated steel producer. And we've got their latest numbers, the 9-month activity report and consolidated financials running up to September 30th, 2025.
And crucially, these are prepared using TMS 29 inflation accounting. So the figures we're discussing today have already been adjusted for inflation.
Exactly. It means we're comparing apples to apples when we look at 2025 versus 2024. We get a clearer picture of actual performance, stripping out that currency noise.
Right. So our goal here is to cut through all that data and pull out what really matters for you, the individual investor. What's the story behind the numbers? What's the big picture strategy?
It's definitely a complex picture this time around.
Okay, before we dive deep, if you find this kind of detailed breakdown useful, please do take a second to like this, share it. It really helps others find this analysis. Right, let's start with the basics. Who exactly is Kardemir?
Well, they're one of the foundational companies in Turkey, actually, established way back in 1937, located in Karabük. They're an integrated plant, meaning they handle the whole process, making coke, pig iron, right through to finished steel products.
And not just any steel products, right? They seem to be focusing more strategically now.
That's a key point, yeah. They're pushing hard into higher value-added areas. Think railway systems, wheels, rails, plus specialized steel for automotive and defense sectors. It's not just about basic construction steel anymore.
So that's a strength targeting potentially higher margin, more demanding sectors.
Definitely. But the flip side, the challenge, is always the volatility of the steel market itself. It's a commodities business, very cyclical. And we'll see that reflected in the sales figures later on.
Okay, structurally, how big are they?
Still a very large employer. As of the end of September 2025, the group had 4,438 employees. That's actually down slightly from about 4,560 the previous year.
And they have subsidiaries?
Oh, yes. Wholly owned ones like Parcel, doing steel construction, Kardemir Energy for power, Kardakmak, Karlimtaş, plus significant stakes in others, like nearly 50% of Customs of Cement. And they've got international branches too. Bulgaria and Hungary are listed, so they have wider ambitions.
Let's talk governance. Who's running the show?
The management board has 10 members listed in the report, with Muhammad Ali of LAZ as the chairman.
And looking at that list, any female representation on the board?
That's noticeable, actually. Based on the provided list, there are 0 women listed as members of the management board.
Okay. Something to note in terms of modern governance standards, maybe.
Yeah.
What about pay for the top executives?
Right. The report details this. For the first 9 months of 2025, the total consolidated benefits, salary, bonuses, perks, everything for top management, so board members, the general manager, VPs, came to 95.6 million Turkish lira.
Wow, nearly 96 million TL. How does that break down?
About 71.7 million TL was from Kardemir itself, and the remaining 23.9 million TL came from the subsidiaries.
Okay. 96 million TL for the top team. We should probably keep that number in mind when we look at the company's overall profitability later.
Definitely. Now let's get into the operational side. How well are they actually running the plants? This is where things get quite interesting.
Okay. What are the utilization rates telling us?
Well, some parts are running flat out. The coke ovens, for example, show over 100% utilization, 100.29% to be precise. And liquid pig iron production is strong too, almost 91% capacity usage. That suggests the core, the sort of legacy parts of the operation are pretty efficient.
But wasn't the strategy about moving into those high-value areas? How are those facilities doing?
And that's the critical question. If you look at their big investment in railway wheel production, a key strategic area for them, the utilization rate was just 11.48% for this 9-month period.
Wait, 11%? That sounds incredibly low.
It is. And what's more, it's actually down sharply from the same period last year, when it was around 20.42%.
So they built this strategic facility, and it's running at barely a tenth of its capacity. Why? Is the market demand not there? Or are there operational problems getting it running properly?
The report doesn't spell out the exact reason, but that low utilization is a major red flag if your strategy hinges on that product line. It really drags down potential profitability.
Especially when you see how much they're investing elsewhere.
Exactly. Despite that low utilization, they are absolutely pouring money into future capacity and R&D. They highlight their R&D center, one of the first in Karabük, working on things like decarbonization, new railway systems products, high-quality steel.
And the list of active projects is huge, isn't it?
It's staggering. The report lists 47 active investment and R&D projects just in these 9 months. Things like a new SDM2 machine installation, increasing capacity at Converter 3, a new PCI facility, plus major environmental upgrades like biological treatment modernization.
47 projects running concurrently. That's a massive undertaking.
It really signals a full-scale modernization effort, and you see the cost of this directly in the cash flow statement.
Right, let's talk CapEx, the cash outflow for investments.
It exploded. In the first 9 months of 2025, they spent over 3 billion TL on investment activities. That's CapEx. Compare that to the 1.7 billion TL, roughly, they spent in the same period of 2024.
So nearly double the investment spending year over year. That's a huge commitment.
It absolutely is. It shows they're really betting big on this modernization and expansion strategy, even with some current assets underutilized.
Okay, so massive spending on the future. How did the company actually perform financially during this period, the first 9 months of 2025? Let's get into those inflation-adjusted results.
Right, the scorecard. Starting with the top line, sales revenue. Consolidated sales came in at 48.2 billion TL.
And how does that compare to last year?
It's a noticeable drop in real terms. Last year, for the same 9 months, it was 54.7 billion TL. So revenue is down. That reflects the tough market conditions we mentioned, the commodity cycle pressure, both domestic and export sales were lower.
Okay, lower sales. You'd normally expect profits to follow suit, right?
You would. But here's where it gets really interesting, and possibly the most crucial point operationally. Despite lower revenue, their margins actually improved significantly.
How so?
The gross profit margin went up. It was 5.18% in 9M 2024, and it rose to 6.51% in 9M 2025. And even more impressively, the EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, jumped from 7.47% last year to 9.13% this year.
Hold on. Sales are down, but they're making more profit margin what they do sell. How do they manage that? Better cost control.
It strongly suggests improved operational efficiency. Maybe lower energy costs, better raw material handling, less waste. Something in the production process allowed them to be more profitable per ton of steel produced, even if overall market prices or volumes are weaker. They controlled costs better internally.
Okay, that improved efficiency must flow down to the bottom line then.
It does, and quite dramatically. The consolidated net loss narrowed significantly. In 9M 2025, the net loss was 955 million TL.
Which sounds like a lot, but compared
to the 3.9 billion TL loss they posted in the same period of 2024, so the loss is almost 75% smaller in real terms, a huge improvement on the bottom line.
a much smaller loss. That's the good news. But you mentioned this performance came at a cost, visible on the balance sheet.
Yes, exactly. While total assets and total equity saw small decreases, kind of stabilization under inflation, the big story is debt.
Ah, the borrowing needed to fuel that massive CapEx spend we talked about.
Precisely. Borrowings have gone up significantly. Short-term borrowings increased from about 4.3 billion TL to 6.6 billion TL. That's a jump.
Okay, more short-term debt. What about long-term?
That's where the really dramatic increase is. Long-term borrowings absolutely soared. They went from just 414 million TL at the end of September 2024 to over 2.5 billion TL by September 2025.
Wow, multiplied by 6 times. That's a massive increase in long-term leverage.
It is. This is the direct funding mechanism for that 3 billion TL CapEx program. They're financing the future overhaul primarily with long-term debt.
That feels like a high-wire act. Taking on that much debt relies heavily on those investments paying off, right? Especially when key new assets are currently underutilized.
Absolutely. The viability of this debt load hinges entirely on getting those 47 projects completed, commissioned, and generating cash flow relatively quickly. That 11% utilization on railway wheels needs to climb, and climb fast.
What about cash flow from just running the business day to day? Cash flow from operations?
Still negative, unfortunately. They had a cash outflow from operations, CFO, of about 705 million TL in 9M 2025.
So the core business is still burning cash.
Yes, but again, context is crucial. It's a huge improvement from the same period last year, where the operational cash outflow was a massive 2.85 billion TL.
Yeah.
So they're still burning cash to operate, but they've slowed the burn rate considerably, likely thanks to those efficiency gains.
Okay, so less cash burn from operations, but massive cash burn on investments, funded largely by taking on a lot more debt. Got it.
Now, let's quickly touch on a few other points from the report that investors should probably be aware of. Footnotes and related details.
Like what?
Well, regarding equity, there was some activity. The report notes that subsidiary Carcel sold some of its KRDMD shares, Kardemir's own stock, back in August and September 2025. This might indicate some internal capital shuffling, perhaps raising cash within the group.
Okay, and related party dealings.
Yes, there are significant transactions listed, which isn't unusual for a large group. For example, sales to a related company, Kardemir Karabük, amounted to 1.41 billion TL in the first 9 months. It shows integration, maybe some guaranteed offtake, but always worth noting for transparency.
Any major risks highlighted in the notes, lawsuits, things like that?
There is one significant legal case mentioned. Kardemir is trying to recover about 44 million TL from a company called Demsen Geri Danushimayesh. They actually lost the initial court case back in May 2025.
They lost.
Yes, the local court rejected their claim. Kardemir has appealed that decision, Istinaf. So that's an ongoing legal battle, a material contingency. If they lose the appeal, that's another hit to the bottom line.
Right, good to track. And finally, dividends. What's the policy, especially given the big investments and the recent loss?
The official policy is quite clear. They state they aim to distribute profits, but investment spending that aligns with their strategic growth plan takes priority.
So basically, don't expect dividends anytime soon.
Given the 47 projects, the 3 billion capex, and the huge increase in debt, yeah, it seems very unlikely. All available cash will almost certainly be plowed back into those investments for the foreseeable future. Dividends are off the table for now, based on their own stated policy.
Okay, let's try to pull this all together. What's the core story here for Kardemir?
I think the main takeaway is this tension. On one hand, they're dealing with lower sales in real terms, reflecting the tough market. But remarkably, they've managed to significantly improve their operational efficiency.
Right, higher gross and EBITDA margins, leading to that much smaller net loss, a 75% reduction. That's impressive operationally.
Very impressive. But on the other hand, they are funding this absolutely massive investment program, that complete industrial overhaul we talked about, almost entirely through debt.
Especially long-term debt, which has multiplied 6 times over. So they've essentially swapped lower current losses for potentially much higher future financial risk tied to this debt burden.
Exactly. It's a huge gamble on the future. The central question for you, as someone looking at this company, is whether this enormous investment, financed by this mountain of debt, can actually deliver.
Can they successfully translate that improved operational efficiency, which they've shown they can achieve in the core business, into sustainable profit from these new high-value added areas?
That's the crux of it, because right now, those strategic, supposedly high-margin assets, like the railway wheel plant, are barely ticking over at 11% utilization. They need to get those running effectively and soon.
So the story isn't really about the sales dip today, is it? It's about execution tomorrow. Can Kardemir manage these 47 projects, get them online, ramp up utilization dramatically, and start generating enough cash to service this significantly higher debt load?
Precisely. Your investment thesis here really hangs on their ability to execute that transition successfully and quickly. That low utilization in strategic assets has to turn around.
So a key metric to watch would be that railway wheel utilization figure.
Absolutely. Keep a close eye on that number in future reports. It's probably the single best indicator of whether their big strategic bet is starting to pay off, or if the debt risk is becoming unmanageable. That's the acid test.
A critical point to watch. Thanks for breaking that down. If this kind of in-depth analysis helps you stay informed, please do share this deep dive with your network. We'll be back soon with our next analysis.